Good morning, everybody. This is Patrick MontesDeOca. We have a real fast market in the gold market here. It's down 32 bucks, 1842, 1843 trading last. We are recommending, if you follow that recommendation from yesterday's video, that you take some profits on the short side. If you came in short, cover your position. We took some hedges as well, and if you took the hedge, lift 50% of the hedge, and pretty much take profits here as the market is now entering what appears to be the 1840 target level, which is the monthly level that we've been looking for, basically, to find the average price support and demand, you might say, or to see the kind of strength that we have down here in terms of buyers coming into the market at these levels here. So we have fast market conditions here. Let's let the market here trade, but cover shorts, cover your shorts, and just watch the market for a little bit from these levels. It looks like we came down here to 1840.70. 1840 is the monthly average price, so we're getting some buyers to show up here. And this is a great opportunity to add to your long-term position. But we got the expected swing correction that we were anticipating, or the VC PMI basically had been suggesting the last couple of days. So market is oversold, and it has come down almost to complete, for all intents and purposes, completed the swing correction pattern, counter trend pattern. Now, we've also come down to a 38.2% Fibonacci retracement at 1847. And so that if we do get above 1847, then it's going to complete that correction down to a 38.2% correction, Fibonacci correction. We want to start to trade the long side of gold from these levels now, obviously, still maintaining a hedge, still maintaining a short-term downward bias that I think is probably going to last until about the middle of the month. So ideally, this correction here could be identifying Potentially, once again, testing the integrity of the previous low that was made at 1667. And this line here, this level here kind of draws the line in terms of the market being able to maintain that integrity, so to speak, of the signal, of the previous signal, in order to classify that low that we made at 1867 potentially as the yearly low, the annual low. And the action of the market this morning is what really is going to be confirming whether that is the annual low, or the market will test that low again by closing, you might say, below 1840. If we were to close below 1840, we have right under the 1821 level, which is the weekly average that we've been pretty much trading all this week. Let me see where the Bollinger Bands seem to fit into this. Yeah, the market is extremely oversold. So the path of least resistance is to pretty much take trades from the long side and use this 1840 level basically as your protective level, that if it reverses, that's where you would get out as a stop. Now, we came down into the average price in the previous short trigger that was identified here, has been completed. Okay, now now that it's trading around the average price, basically the AI tells you to just simply watch the market go neutral on the futures contract. If you took the short, cover it and just watch the market from here. You don't need to trade from here, but simply recalibrate your strategies. As I said, if you came in short in the futures, you make your target, and also you can recalibrate your short hedge, your short term, short triggers that were activated. We're coming into a level of support is what I'm saying. So it's time to cover any short positions, hedges, and start to look to get on the long side. Above 1847 is going to validate pretty much the confirmation that the low is in. So the AI recommends, obviously, the highest probability trades would be the market coming down into the extreme below the mean, but we're far from that. Obviously, if you see on the left of the chart, you got the daily at 1857, and that would be the first anchor to get on the long side. In the meantime, the market is extremely oversold. So let's just watch the market here and see what it does from here in the gold market. Silver is in pretty much the same condition, extremely oversold. The copper is in a short trigger. It's bearish. The mini S&P is pretty much experiencing resistance up here into this zone of 3691 to 3719. And this is the instrument that we recommended basically to hedge on this correction here. And you can see it's gotten to the sell one level and activated now a short trigger. So this is why I'm saying to you that you want to be covering shorts if you you know, pretty much if you came in long the dust, which is an ETF, an ETN, I should say, that we trade to hedge against any kind of correction in the market. Short term, we're looking at a short term correction in gold. This is not the end of in the completion of this pattern yet. The market still has to challenge, you might say, the previous levels and see what kind of supply it's going to find up there. Whether the market made the all-time highs at 2089, whether that's going to be a long-term top in the market, or there is still a chance that we can get up to that 2140 level, which is the 360-day cycle that we're looking at. Let me go back to the gold here, and I want to see what the long-term signals look like. This is the long-term chart that I use with the monthly and the annual information, as well as the 9-year cycle here. And you're looking at the monthly 1840 level being tested right now, and it looks like we found, some kind of buying here. When you see this sell-off or this supply come into the market, when the supply is greater than the demand, obviously it's reflected in the price, and you get these bars coming down here. When it comes down to the target expected, in this case the 1840 level, and you get this reversion to occur, this kind of identifies for you the beginning of demand or buyers that come into the market, which is reflected in the green bar. And you can see right below that, we have the 360-day average price at 1810. So the way I look at this is I would recommend, if you are looking to, add to your long-term position, use this levels anywhere between 1840 and 1810 to get on the long side, if the market gives you that opportunity. But it may not. It may just have made this low here today and showed up, buyers showed up at these levels here. So we are getting an interesting development here. Let's watch the market here a little bit. I want to focus on some trading here today and some real signals for you guys. The daily chart looks pretty bearish by this big bar making a pretty much a daily reversal here to the downside. What we want to see is the kind of support in this area of 1840 to 1810. You could see the market made a high yesterday right into this trend line resistance, and it failed to go through. And to me, this was a clear sign that we could see this kind of sell-off today. I haven't looked at the news, to be honest with you, this morning. I don't know what is driving the fundamental picture in the market. Very much like it did here, for example, when the market back in November 6th tried to get up through that high or that trend line resistance level of 1967. It met ferocious sellers due to the pandemic, due to the vaccine findings and efficacy projections, you might say, that showed there are 2 or 3 highly potential vaccines that are going to be implemented. So the market took this bearish, okay? But one of the things that I want to comment here is that the gold market is not trading based on the vaccine news. What the gold market is trading is the economics of the system that the pandemic basically uncovered, which was a pretty fragile system full of debt, and on the verge of potentially, breaking. And it didn't take much, for this system to break, as it did back in March of this year. Not, it seems like ages ago, but it was, it was only in March that we experienced this devastation, this pandemic that completely devastated the global economic system. And so we're in the midst of, I believe, a transformation of the old system, basically as we knew it, to a new system. And I think we're looking at a virtual system. We're looking at a virtual economy. The economy pretty much made the change in paradigm, back in March when the market collapsed to 1461. And this leg here that we're looking at from 1461, 62, all the way to 2099, which was in excess of a $600 leg, was basically the reaction to the pandemic and potential damage that it may cause. Nevertheless, what appears that has happened up here is that the market at 2099 discounted the news of the damage, and we got the Feds to come in and announce some record stimulus, record quantitative easing to take place, and announced, or I would say prepared to leverage up to 10% of the GDP to set aside for this potential damage that we didn't know yet. Nobody knew. And it came in in a timely manner because the markets took that very positively. And obviously, if we take a look at the mini S&P, it went into a high new highs, which is currently trading at 3,700. But also the E-mini is experiencing some challenges up here, some resistance. And so the question is, are we going to find some buyers down here in the gold market? And is the stock market in a topping formation? That's the question. So for that answer, we look at what the market is doing against the monthly signal. And we see that the market is extremely oversold into this area. We're going to go flat here on dust. We took a position. If you came in with a hedge, the market is giving you a great opportunity to lock in some profits here, and we're booking about $45,000 if you follow the recommendation, and we are trading in real time in a real account this information that I'm sharing with you. We continue to look for the market to show support down here. This is the 15-minute bar that we use to trade the market. And it continues to attract some buyers into the market here. And pretty soon what you'll start to see is the bar turn green. I would book the dust profits if you took dust, or again, any bearish trade that you might have put on. One of my traders asked this morning, or basically, you're hearing a lot of commentary on Bitcoin as competing with gold, and let me just bring this forward to you. I've been trading this for quite some time, and I can tell you that there is no product in the world that is basically, particularly virtual product, that is going to compete with a currency that has been around for thousands of years. Bitcoin has only been around for 10 years, and you're hearing a lot of pundits making stupid comments about, oh, it's eliminating the gold market. Let me bring a couple of things into focus. First of all, ladies and gentlemen, Bitcoin is not a currency. It is a virtual asset. A real currency is used as fiat money. Is used as tier 1. Which means that it can be used to collateralize any deal or any situation that you need that protection. You cannot use Bitcoin as a tier 1 asset, and therefore it is not a currency yet anyway. Now, if they were to create a virtual currency that would be backed by some kind of metal, and then agree that it is and can be used as a tier 1 asset in terms of the currency unit, as a currency unit, or even in the monetary system. The only thing that people fail to realize is that by creating Bitcoin, the only thing that the leaders are doing is basically substituting Bitcoin for fiat money with no backing. And so we're going to see what kind of backing, if there's going to be backing behind some of these virtual currencies that are being traded. But I would not be surprised, first of all, that if the central banks around the world, our own government, decides to issue a virtual currency, it is not going to do it on the face of this public domain that has been created, which is primarily used for black market, dirty money, laundry money right now in the marketplace, as we know it. But I can almost make you a bet that if the governments are going to use this virtual asset, they will eliminate or even make it illegal for other entities that are not registered, you might say, or regulated to use it as a currency. Now, it's a tradable asset, you know, and what we do is we trade the Bitcoin, the GBTC, the Grayscale Bitcoin Trust, that essentially is the trust for Bitcoin. And it is regulated. And so at least if I want to trade the virtual market, I can do it in a regulated environment. And you're getting a lot more institutions also interested in the Grayscale Bitcoin Investment Trust Fund, because it is the only, excuse me, the only fund that has been created to trade Bitcoin. So if you want to trade Bitcoin, use it as a as an asset, as a tradable asset. The volatility is tremendous, but it is not competition with gold. As long as I've been around, I can tell you that it doesn't come close, because again, it's a virtual currency. It's monitored virtually. The technology that creates it is electricity. And, just think about the possibilities that if something happens with technology, or what happens if you can't get into your account? Also the chances of getting hacked, and so on and so forth. There are, inherent risks that I believe you got to take a look at. And, if you're willing to take the risk, who's going to tell you not to? Personally, I'm trading a GBTC because it is a regulated instrument. And, what I'm interested is in building cash balances, increasing my cash balances. So, in terms of the political argument, whether Bitcoin is going to compete with gold, or, it's hard to say. The only thing I can tell you is that gold, again, is God's money. It's been around for thousands of years. And for right now, obviously, it is experiencing a lot of different challenges in terms of, the classification, whether we're going to see it as a virtual currency or not. It is a virtual asset, ladies and gentlemen, with inherent risks that I think we'll see unfold as we move into a more accelerated phase of what I believe is going to be an implosion in the real US dollar as the real reserve currency, which is the reason why the market is looking for alternatives. People are looking for ways to protect themselves, against what is inevitable coming, and that is essentially an implosion on the US dollar, a devaluation of the US dollar as we speak. The fact that the government is publishing all this stimulus, it's creating money out of thin air, is another way of devaluing the purchasing power of the US dollar. It's another way of diminishing day by day the integrity of pretty much the intrinsic value of the US dollar as the world's reserve currency and the purchasing power. Most people don't realize that, but it is the silent killer. And the fact that the government is willing to print up to 10% of GDP, wow, look what that would do to the US dollar. And so people are running for ways to, kind of prevent the inevitable. And that is that whatever assets you may have in the US dollar as a denominated currency in its asset, so to speak, it's running the possibility of if the dollar does implode, and if we do run into a situation where again we get pretty much a lot of resistance from global economies to use the dollar as the world reserves currency, we're going to be facing with potentially a lot more competition. China is coming in with a virtual currency. They already are dealing in a virtual economy, almost 100% in China. You can go buy a loaf of bread, with cash. There's no cash around. I personally, myself, am experiencing going to small businesses, fast takeout stuff. They don't want coins. They don't want money. And so people are now with this panic that we have, that this new spike that we have in the virus seems to be spreading out of control, and we seem to have lost the way that we can manage this health issue, this health crisis. We're talking about things getting better 6 months down the line, but in the meantime, we have to deal with the current situation. We have a holiday coming up, and it's going to be real difficult for most people, if not for everybody that's been affected, obviously, by this tremendous chaos, this economic chaos that was not anybody's fault. I think in looking at the blame, so to speak, we can have a real serious discussion in terms of what was the beginning of the demise, you might say, of that brought us to this current situation. In my opinion, just to be very upfront with this stuff, I believe that the worst mistake the U.S. made was lifting the gold standard of the U.S. dollar, and that was the beginning of the downfall of the U.S. dollar as we knew it, and it became a fiat currency. But I believe the intentions behind it was really not for the benefit of mankind. Look how many, how many billionaires have been made in the last 10 years, or even if you look at the wealth that's been created as a consequence of all this debt creation, us moving us into a debt economy, pretty much since the Federal Reserve was created, but the acceleration of the U.S. dollar as the world's reserve currency actually was in 1971, because it was pegged to gold prior to that. And so are we going to have another Bretton Woods moment here as we move into the next year? Will the officials consider possibly using gold in some form of a reserve or backup to the currency? We don't know. It doesn't, from what I, am looking at in also for myself, as a trader and my subscribers and so on and so forth. How do we deal with a situation like this? Well, my opinion is that our leaders are going to continue to move into a debt virtual economy now. We're coming out of a physical economy that collapsed under weight of its own debt globally, which is unsustainable. As a consequence of that, interest rates had to come down to 0 or near 0%. And this has never happened in the history of the world. And so how can an economy, a world economy, any economy, function with negative rates? is beyond me. How can pension funds, deal with negative interest rates? Are they going to eat the principal? I mean, it raises a lot of questions. And also the big question, and the reason why interest rates are at these levels, and they're going to be around these levels for quite some time, is the enormity of the debt that we carry, which is like 23 trillion, or maybe even more now. And so interest rates cannot go up. It will break the back of the yield curve and create a true depression, unlike we've never seen before, by collapsing asset values now, which could be detrimental to the world economy, to our own economy. And that would be going into an implosion, a deflation of real asset values. That I believe, unless they, or what I mean they, our officials, change the policies and begin to implement policies that are not conducive for debt, additional debt, maybe I feel it could work. But the only thing I believe it's happening here is that we're going in, first of all, from a physical economy as we knew it into a virtual economy. We went into this virtual economy back in March of this year. And the stock market obviously understood that, and it separated from the reality of the tremendous pain that Main Street was experiencing as a consequence of this pandemic. And so the wealth gap expanded even more, where the elite, or the lucky ones, so to speak, that are in a position to go out and borrow millions of dollars at zero interest rates and dump it back into the market in their portfolios of their own stock, continues. And it's going to continue, because the only thing that's going to make a difference here is that we're going to be moving in from a fiat currency full of debt that cannot be sustained. The only way to wipe out that debt is by imploding its currency, or the debt, or the currency that the debt is in, to zero. It doesn't take a rocket science to figure out that is one way of doing it, but it is simply a what I believe is a sleight of hand way of devaluing the currency. Very much like Mexico was in 1981, that they couldn't pay the U.S. debt at the time. And they were in a position basically where they couldn't print U.S. dollars to pay the debt. The alternative that they had was basically to default on the debt and devalue the currency. If you go back and you look at what happened to the peso in 1981, it went from roughly about 16 pesos to the dollar to where it is now. It's thousands of pesos to the dollar. And in doing so, it depleted the debt in its currency, in the old currency. Or you paid, the debt with a fraction of what it was. So in a sense, the U.S. is doing the same thing, except they're not really devaluing the dollar per se officially and saying, no, we're going to devalue the dollar by 10%. They're doing it by printing money quietly. And it is staggering, the trillions in the amount of money that the market is going to have to be faced with as a necessity for us not to go into an implosion and a collapse in asset values here in the United States and around the world. Because what happens here in the United States happens, if the United States, sneezes, Europe catches cold. And the fight to get out of the US dollar as the reserve currency continues to be challenged by China, by Russia. And so the talk about, obviously, what currency we're going to be using in the future, obviously, is at the table. But coming back to my opinion of Bitcoin, Bitcoin is a virtual asset. It's not a currency. And the way you trade it is, again, as a virtual asset with all its risks, but you can't compare it to gold as a currency. It's just not the case. Coming back to the gold market here, we're trading last at 1850.51. As you can see, the market reverted as expected from the average price of 1840, and as it continues to go through and trade through the 1847, 38% retracement, it's also validating and completing all of these expected patterns in order to identify the direction of the market. So I've been saying here throughout the session early this morning, cover shorts, hedges, and so on. And the confidence that I get to do that is because I believe that the VC PMI information is not 100% guarantee, but it is a mathematical probability that allows me to make intelligent decisions in my trading, whether I'm day trading, swing trading, or position trading. And this is what I'm teaching, coaching my traders. And I'm very, very happy to see and hear that, most of them are doing very well. They're beginning to understand, they're beginning to apply it. And if they just continue to follow the discipline of the application, controlling, basically not trading, for the sake of trading, waiting for the highest probabilities to trade when the signals are produced, ideally when harmonically identified, their trading results are changing. This is real. I use it for myself, and I have no problem at all sharing this information for the benefit of those that are serious traders that want to make a difference in the bottom line. These markets are historically providing the opportunity to make fortunes if you do it intelligently. This crisis is an opportunity. It's at the same time a situation that is a global crisis that we're dealing with right now economically, but it is also a historical opportunity for you to be able to use these instruments and make a difference. You have the options, you have the control, you have the ability to make the decision that regardless of what this system brings you, that you can recalibrate yourself, that you can recalibrate your objectives and protect yourself, protect your wealth, protect your net worth, protect your family, and which is pretty much what I'm doing here. And I'm extending that in terms of sharing this with you here so that you as a self-directed individual can use this information to protect yourself. Not only to protect yourself, but to also benefit and capitalize and monetize out of a crisis situation. Crisis in this business always is an opportunity. It creates volatility. And for a trader, volatility is a dream come true. 1850, 50, 51, you know, trading above 1850 is psychologically a good omen, so to speak, you know, that the market showed that although it came down to this low here, close to 1840, that was precisely the monthly average that we're looking at. We saw these buyers come in that I pointed out to you. Now, this is the market confirming and validating what the AI it tells you to expect. And so having that prospective information is tremendous, because it allows me to position myself intelligently and manage my risk accordingly, so that when we do get this kind of confirmation, you know, you jump all over it, you know, particularly if we get the market to get up above 1857. Now we're anchoring in the daily, okay? And as I said, we begin to engage, you might say, the cyclical patterns, the wave patterns, the momentum of the market, you know, the trend direction of the market that essentially is identified by these levels. We're getting more buying coming in here. As you can see, 1857 is the target. Now, again, a close above 1857 is going to bring in a buy trigger from the extreme level below the mean, which will activate a 90% mathematical probability if the signal is activated from that level. So this is how I use pretty much all of the signals here, you know, in combination of the different trends. And what I look for is basically the price relationship. The price relationship to these levels is what really activates the trend momentum, the sentiment of the market, but particularly shifts the patterns, you might say, you know, from long to short to neutral. 1851 last, 1850.90 bid, 51.20 traded. Getting some good buying in here. I think the market gave us an opportunity to jump on the long side again. We've been recommending this. It happened here. We're looking at the market possibly completing this correction here. Again, for the day trade, short term. And let's see what the market does for the rest of the day as it continues to take out the supply that is being offered from this 1857, 1866 levels. Just to recap here what I said here, we've covered all our short hedges. We recommended to take profits on the short side. The pattern was completed as expected, and the market has reverted from the monthly average of 1840, creating a bullish price trend momentum that is activating the first target of 1857. And a close above 1857 activates 1866, which is the sell to level, basically. Let me just make a minor correction here. The 1857 is a 90% probability that if it anchors the trigger, the buy trigger, you're looking at a reversion back up to 1866, and then eventually the target of the daily average of 1873. Continue to hold your long-term position. And use this, again, corrections to add to the long-term position, which still has the target of 21.40, 21.50 as the expected target here for the next few weeks. Thank you again, everybody, for the privilege of your time. Please take care of yourself. Be well. I'll talk to you soon.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
The Ticker Talker app brings the powerful trading technology tools of the Ticker Talker desktop platform into the hands of its users